What is the practical implication of JPMorgan and the FDIC agreeing to share the burden of losses?
Sure. So as JPM now has the assets and deposits, they will work through those, and particularly loans. As they collect those loans, there'll be a loss share agreement for any losses that come out, and then that will be shared with the FDIC. It's very similar to what we had in 2008, 9, and 10. Typically, the assets back then were much worse. These are assets that are simply marked for interest rate risk, not for credit risk. So ultimately, I think you'll see JPMorgan sit with these assets and sell them and move forward. It's possible that much of what they are holding here comes back to them in the next 12 to 18 months. If interest rates change and the Fed changes policy, perhaps a quarter or two from now, that's going to have a sea change to how these assets are valued. So timing is everything, and I think that's ultimately why the bid ended up being less of a discount for JPMorgan than the other banks.
And so are they sharing the upside on this too?
They capture most of the upside. So I think the upside all goes to JPMorgan.
It's interesting because some reports suggest that JPMorgan and the FDIC agreed to share both the upside and the downside. But it seems like JPMorgan ended up with all the upside while the FDIC is trying to avoid socializing the losses and privatizing the gains. Please can you provide more clarity on this issue? What sources are you relying on for your understanding of the situation?
Well, I think the loss share agreement is going to be very typical to what we saw back in the transactions in 2008, 9, and 10. It was a very typical loss share arrangement where the FDIC seized the bank, they cut a loss share arrangement, and then the bank collected the assets. The bank becomes the conduit for the FDIC to collect the money, to collect the loans. It's less of an issue with deposits, it's much more with the loans that were made. And remember, the loans that First Republic had were largely low rate mortgages with low loan to value. So these are not risky loans. In fact, in many cases, these are very low risk loans. They simply had interest rate risk because they were done at 3.25%, 3.5%, and the mortgage market today is closer to 6%.
Given that JPMorgan already held over 10% of US deposits, which has raised concerns with regulators, can we assume that they have been granted an exception to this limit given the current authorization?
Correct.
Does exceeding the 10% threshold of US deposits become an issue? Was the limit set for a specific reason, and why are we now willing to surpass it?
No, I think at the end of the day, if you had to take a lower bid and therefore a bigger loss for the FDIC and for the deposit insurance fund, it would have been problematic for the other banks. The other banks would have had to pay more than they already are paying. You know, the cost of FDIC insurance will go higher in the coming quarters and next year. So if you could limit the hit to the DIF, to the deposit insurance fund, that really is the best outcome for both the banks and for the system. So ultimately, this is about building confidence, and I think you build confidence, A, by having First Republic resolved, and B, by seeing that a very good operator who has strong capital, remember the fortress balance sheet that JPMorgan has always advocated, that allows them to do the transaction. I think it's going to be rare. I don't think we're going to see others like this. It really was the bank that was caught by the friendly fire of SVB 6 weeks ago.
JPMorgan has agreed to acquire First Republic Bank's deposits and loans. This includes low-risk mortgages with interest rate risks. As part of the acquisition, there will be a loss-sharing agreement with JPMorgan and the FDIC. This means that if any losses occur, JPMorgan and the FDIC will share the losses. By acquiring First Republic's bank deposits, JPMorgan total US deposits will exceed 10%. This has been seen as problematic for regulators in the past, but the decision to allow this acquisition may be due to the desire to limit the hit to the deposit insurance fund and build confidence in the banking system. Although this type of acquisition is rare, JPMorgan's strong capital position and ability to execute the transaction demonstrates their expertise in this area.